Options are powerful financial instruments that give investors the ability to make directional bets, hedge portfolios, and generate income. Unlike stocks, which represent ownership in a company, options are contracts derived from underlying assets, typically stocks, ETFs, or indexes. With intermediate experience in the stock market, you may already understand basic mechanics like buying low and selling high, or using stop losses to manage risk. Options, however, offer a whole new layer of strategic complexity, which, if used wisely, can dramatically enhance your portfolio's flexibility and performance. At their core, options grant the right but not the obligation to buy or sell an asset at a predetermined price, called the strike price, before a specified expiration date. There are two main types of options, calls and puts. A call option gives the holder the right to buy the asset at the strike price. So a put option gives the holder the right to sell it. Buyers of options pay a premium for this right, while sellers or writers receive the premium in exchange for taking on the obligation to fulfill the terms of the contract if it is exercised. For example, let's say you purchase a call option on Apple AAPL with a strike price of $150 and a premium of $5. The stock rises to $170 before expiration. You can exercise your right to buy it at $150, gaining $20 per share in value, minus the $5 premium, for a net profit of $15 per share. If the stock remains below $150, your option expires worthless, and your maximum loss is the $5 premium you paid. Conversely, if you buy a put with a strike of $150 and the stock falls to $130, you can sell it at the higher strike, netting a profit. This asymmetric payoff structure is one of the main appeals of options. They allow for large upside potential with defined downside risk for the buyer. Understanding key terms is essential. The strike price is the level at which the option can be exercised. The premium is the cost of the option. Expiration is the last date on which the option is valid. If the stock price is favorable to the option holder, the option is said to be in the money, ITM. If it is not favorable but has time value remaining, it is out of the money, OTM. An option is at the money, ATM, when the stock price and strike price are equal. All options lose value as they approach expiration due to time decay, which we'll explore more when we talk about the Greeks. Speaking of the Greeks, they are vital tools in understanding how options behave. Delta measures how much an option's price will change given a $1 change in the underlying stock. Delta of 0.50 means the option will gain 50 cents for every $1 the stock moves. Gamma measures how much the delta will change for every $1 move in the stock. High gamma can lead to rapid shifts in an option sensitivity. Delta represents time decay, how much value an option loses per day. As expiration nears, delta increases, especially for ATM options. Vega measures sensitivity to implied volatility. Options gain value when volatility increases. Finally, rho measures sensitivity to interest rate changes, though this is more impactful on longer dated options. Options derive their value from both intrinsic and extrinsic components. Intrinsic value is how far the option is ITM. For calls, it's the stock price minus the strike price. For puts, it's the strike price minus the stock price. Extrinsic value, also called time value, is the amount above intrinsic value that reflects the remaining time to expiration and implied volatility. The longer the time and the higher the volatility, the greater the extrinsic value. When you buy options, you are paying for both. As time passes, extrinsic value decays. This is why the option seller collects a premium to take advantage of time decay. Options pricing models help estimate fair value. The most famous model is the Black-Scholes model, which calculates theoretical prices based on current stock price, strike time to expiration, volatility, and interest rates. While you won't need to do the math yourself, understanding these inputs is critical. For example, all else equal, an increase in volatility will raise the option price. This helps explain why options tend to get more expensive before earnings announcements. Volatility increases due to uncertainty. There are also different types of options based on exercise rules. American-style options can be exercised at any time before expiration. European-style options can only be exercised on the expiration date. Most equity options in the U.S. are American-style, while many index options are European-style. There are also LEAPs, long-term equity anticipation securities, which are simply long-dated options, typically 1 year or more. These are useful for investors who want long-term exposure with limited capital. Finally, index options such as SPX are settled in cash rather than shares, making them attractive for traders who don't want to worry about assignment and ownership. With this foundational knowledge, you can explore a variety of option strategies tailored to specific goals and market conditions. The simplest and most popular is the covered call. Here you own 100 shares of a stock and sell a call against it. You collect premium income, and if the stock rises above the strike, you sell it at that level, effectively capping your upside. It's great for generating income in sideways or mildly bullish markets. A protective put, on the other hand, involves buying a put option on a stock you own. This acts as insurance if the stock falls, the put rises in value, limiting your losses. More complex strategies include vertical spreads, where you buy and sell options of the same type call or put with different strike prices. A bull call spread, for example, involves buying a call at a lower strike and selling a call at a higher strike. This reduces the premium paid but also limits the upside. Conversely, a bear put spread profits from downward movement with similar risk-defined structure. Calendar spreads use different expiration dates and can profit from time decay differences. Diagonal spreads combine different strikes and expirations for advanced time and directional plays. If you're expecting significant movement in either direction but don't know which way, straddles and strangles are volatility-focused strategies. A long straddle involves buying a call and put at the same strike. It profits if the stock moves significantly up or down. Strangle is similar but uses OTM options, making it cheaper but requiring a larger move. In call markets, iron condors and butterfly spreads are popular. These are range-bound strategies that collect premium and profit if the underlying stays within a specific price window. When using options, understanding risk and reward profiles is essential. Buying calls or puts has limited downside, the premium, and significant upside potential. Selling options, especially naked calls or puts, can carry enormous risk. That's why margin requirements for sellers are strict. Many intermediate investors fall into the trap of selling too many puts, thinking this stock will never go that low, only to get assigned during a market crash. Always have a plan for assignment and capital reserves to manage it. Options also carry tax implications. Short-term gains from option trading are taxed as ordinary income, which can be higher than long-term capital gains. Some index options like SPX fall under Section 1256, which provides a favorable 60-40 split between long and short-term capital gains, regardless of holding period. Wash sale rules can also apply, particularly if you're using options to lock in losses and re-enter positions. It's always wise to consult a tax professional when trading options at scale. Market conditions play a huge role in how you should trade options. In volatile markets, implied volatility increases, making options more expensive. This is a good time to consider selling premium via spreads or iron condors, assuming you believe volatility will revert. In stable markets, premiums are lower, and strategies that rely on time decay like covered calls and short puts are more effective. Being aware of the implied volatility rank IVR of a stock can help determine whether an option is relatively cheap or expensive compared to its historical levels. You can also blend technical analysis with options trading. For instance, if a stock is approaching a strong resistance level, you might sell a call spread above that range. If it's at a support zone with bullish indicators like RSI divergence or MACD crossover, buying a call or put spread might make sense. Some traders also use moving averages and Bollinger Bands to time entries and exits. Options are uniquely suited for these kinds of tactical moves because they allow for defined risk and strategic flexibility. Still, many traders make common mistakes when dealing with options. One is over-leveraging, buying too many cheap OTM options with the hope of hitting a home run. These options often decay to zero. Another mistake is holding through earnings without understanding implied volatility crush. Even if the stock moves in your direction, a drop in IV can reduce the option's value. Some traders ignore the Greeks entirely, not realizing that time decay or volatility shifts are eating into their position. Always choose the right strategy for the market environment and know your maximum risk going in. In conclusion, options are a versatile and nuanced tool that can transform the way you trade. They allow you to express complex views on market direction, volatility, and timing. Used properly, they can hedge portfolios, boost income, and amplify returns. But they also carry unique risks, particularly when sold naked or used without proper understanding of the Greeks and volatility dynamics. As an intermediate investor, mastering options requires not just technical knowledge, but strategic awareness, discipline, and risk management. With continued study and practice, options can become an essential component of your investing toolkit.